My next guest says higher inflation is helping build a, quote, strong case for the Fed to delay rate cuts this year, possibly into December. Let's bring in Richard Clarida. He is PIMCO's global economic advisor, the former Federal Reserve vice chairman. It's good to see you again. Welcome back.
Thank you.
So I'm just going to ask you straight up. Do you think the Fed's going to cut this year?
I do think they're going to cut this year. Everything that's interesting in markets is a probability, but I think the odds are that we do get at least one rate cut this year. Yeah.
Is that your baseline, one? And if so, what was it, let's say, a few months ago?
Well, you know, I was taking my lead from the projections, which coming into the year indicated 3 rate cuts. Given the data we had coming into the year, that looked like a pretty sensible path. Of course, since then, the inflation data has been disappointing and the economic data has been strong. And so I think dialing back the expected number of cuts makes sense. I do think that this Fed is in data-dependent mode right now, and that the data could either improve or get worse, and that will dictate the path. But I do think we're going to get a cut, yeah.
I mean, Jamie Dimon, an hour ago, described the U.S. economy as, quote, unbelievable. It doesn't sound like there's any need to cut rates.
Well, and certainly on the growth dimension, Jamie is right. Of course, the Fed's looking at the inflation data. The Fed's also judging that policy is restrictive now. So cutting rates a bit is not running an easier policy. It's just removing some tightening right now.
What do you expect the PCE to show this Friday after, let's be honest, the last few inflation reads, certainly CPI related, were a setback to say the least?
Yeah, no, they have been. Our team, which does a great job on this, thinks it could round up to 0.3%. It's probably going to be right in that range of 0.25 to 0.3%. And, you look at that number in isolation, it doesn't seem very big, but multiply it by 12 and you get 3.6, which is too darn high. So yeah, the Fed would like something at 0.2 or below for sure. I'm going
to put you back in the room, as I like to do, the room where it happens, so to speak. So here we are. We're in April. We have an election this year. So where does the election factor in? And if you were still in the role in which you once sat, how would that go through your own mind as to what the sort of deadline is before it's off limits?
It's a good point. I think there are a couple of issues here. First, historically, the Fed does adjust rates in election years just because the economy calls for it. We've seen hikes and cuts out of the Fed. When I was there in 2020, we cut rates. It had nothing to do with the election, but the economy collapsed in the pandemic. Look, I think the Fed is an independent institution. It'll make the call for rates based upon what it thinks it needs to do to deliver price stability. I would say that the way the calendar lines up, the November meeting is right after the election. So I think it would make sense if the committee thinks it is going to cut to get those rate cuts in before November, I would say. But I think the judgment is, what do you need to do for the economy? And I think that'll dictate it.
How are you thinking about the danger in waiting too long? What's strong today in terms of the economy might not be strong tomorrow. Yeah. And the last thing I'm presuming that the Fed wants is to have broken something, whereas it's really difficult to fix it once the glass shatters.
It is a great question, and I'll be very honest with you. I would come down on probably the more hawkish side of that debate. I think there is path dependence here. The fact that inflation's been above 2% now for 3 years would indicate to me that I think getting the price stability and anchored inflation expectations would take priority. Obviously, if you get a lot of flashing signals, you want to factor that into account. But I think in a close call, I would err more on the hawkish side of fewer cuts than more cuts this year.
Let's discuss the target, right, of 2%, or trying to get to target. And that maybe the Fed cannot get it down to target because we're just not playing the game the same way that we used to. I'm curious as to whether you heard the comments from the economist Joseph Stiglitz today on CNBC, who said because of the pandemic and the wars and work from home that have led to this inflation in the first place, it's going to take a long time to work off the effects. We're not in a demand-led inflation boom. And even the Fed chair himself has suggested that, and I think maybe, changed his view on that issue over time. So how does all that factor into trying to get to 2% when maybe you can't get there anymore?
Well, the way I've put it, I think also on your show in the past, is I've thought all along, going back a couple years, that the real plan, the hope a couple years ago, was to get inflation, in the zip code, in the vicinity of 2% from above. It's what I called the 2-point-something destination. I think is a round number, around 2.25%, 2.5% per year. At that point, is it really worth, disrupting the economy for that last 3 or 4 tenths? I think probably not. And I think in that case, you run on balance a somewhat restrictive policy. And you think over time, and I agree with my good friend and Columbia colleague Joe, a lot of this has been supply driven and it may take more time. And so, yes, I would agree that, keeping rates where they are, beginning to adjust down so long as inflation is in that 2.25% to 2.5% range, I think makes a lot of sense.